Hello, doctor, and my fellow friends. So, we are from Group 1, and today we will be presenting questions from Chapter 4, which is Cash Flow and Financial Planning, on the question number 3, 7, 11, 17, and 22. So, firstly, let me introduce our team members. So, Group 1 consists of 6 members, which are Eunice, myself, and then Huang Zexing, Lim Zhising, Li Jiani, Lo Weihong, and Li Xinyi. So now I will be presenting question number 3, which is a question related to MACRS, depreciation expense and accounting cash flow. Pavlovich Instruments Incorporated, which is a maker of precision telescopes, expects to report pre-tax income of $430,000 this year. The company's financial manager is considering the timing for purchase of new computerized lens grinders, and the grinders will have an installed cost of $80,000 and a cost recovery period of 5 years. They will be depreciated using the MACRS schedule, which is on the table 4.2 at the textbooks. So for this context, there are two questions, which is question A and question B. So for your information, this is the MACRS table mentioned just now, and you can find it in the textbook. So for question A, if the firm purchases the grinders before year's end, what depreciation expense will it be able to claim this year? So based on the table, MACRS table, and then in the question, it mentioned that the recovery period for the grinders will be 5 years, and then the firm purchases the grinders before year's end, so it is basically 1. So you can see that the percentage is actually 20%. So to calculate the depreciation expense if the firm purchases the grinders this year before the year end, it is actually $80,000 and then multiply by the 20%, and then you get a total of $16,000. So in conclusion, the depreciation expense that is able to be claimed this year is $16,000. So for question B, if the firm reduces its reported income by the amount of the depreciation expense calculated in Part A, what tax savings will it result? So for the solution, I will give two examples, which are the one in Malaysia, in US. So in Malaysia, the corporate tax that I know is 24%, and in US, the corporate tax is 21%. So to calculate tax savings, you actually need to take depreciation expense multiplied by the tax rate in particular country. So for the depreciation expense is the one you calculated just now in question A, which is $16,000, and then you multiply by 24% for in Malaysia, the corporate tax. So you will get 3,840. So for the one in US, the calculation way is also the same. You need to take $16,000 and then you multiply by 21%. So you will get $3,360. So in conclusion, if the firm reduces its reported income by the amount of the depreciation expense calculated in Part A, the firm would have saved 3,840 for the one in Malaysia, or $3,360 for in US in the taxes.
A very good day to Doctor and everyone. My name is Zhexin. Here I'm going to present next about how funding operations and free cash flows from cash corporation income statement. So in the first question, it requires us to find net operating profit after taxes for this year. From the table, we can find the earning before taxes and the tax rate according to the formula. Then we just substitute the data into the equation. NOPAT is equal to 2,700 multiply the outcome of 1 minus 21%. The final result for the firm's net operating profit after taxes will be $2,033. So next question is to find the amount of their operational cash flow. So based on the table and the equation, we can get the result amount by only adding both NOPAT and depreciation expense. which is 2,033 plus 1,600, and then we get final result of firm's operational cash flow for this year is $3,733. Alright, let's into the question 3, which requires us to calculate the firm's free cash flow for the year. So we have the function free cash flow is equal to operational cash flow minus net fixed assets investment minus net current assets investment. So the first step is to calculate NFAI first, which is the combination of net fixed assets plus depreciation. So we use the result of net fixed assets in this year, 14,800 minus the net fixed assets in this year. In the last year, 15,000, then plus the depreciation expense, and we have 14,000. Next step is to calculate net current assets investment. This is the change in current assets, 8,200 minus 68,000 minus the change in account payable plus accruals, and the sum of 1,600 minus 1,500 plus the sum of 200 minus 300, and then equal to 1,200. Okay, last step is to use these figures to calculate the final amount, which is 3,733 minus 1,400 minus 12,000 equal to 1,133. So the last question is basically to interpret and conclude the previous data. So the operating cash flow is basically cash flow made by the company's main operational activities, and it does include capital expenditure. OCF in this case is 3,733, which is showing that business has actually made a stable high level of cash flow from its daily regular operations. On the other hand, free cash flow is the leftover of cash flow after expenditure is subtracted. This means that amount of cash that the company could have and use for reinvestment or give to other shareholders. Here FCF is 1,333, which is much lesser than OCF. In short, all these have clearly shown that company business are quite strong and have generated massive cash flow as shown by high OCF. However, due to extra investment in working asset and fixed capital, FCF has also decreased a lot to just $1,333. This probably is in process of renewing or expanding in its assets. The business currently maintains some free cash flow, but the low FCF has indicated that there are not many funds available for short-term investment or distribution to shareholders. All right, that's all from me. I'll pass to next presenter.
Good day everyone, I'm Wei Hong. Now I'll talk about the next question, which is P4-11, Cash Budget Basic. Farmers Delight Corporation reported sales of $350,000 in June, $380,000 in July, and $390,000 in August. The forecast for September, October, and November are $385,000, $418,000, and $429,000 respectively. The initial cash balance on September 1 is $150,000, and a minimum of $8,000 should be kept. Use the given information to compile a cash budget for the months of September, October, and November. So the extra information are shown as below. Number 1. Farmers Delight predicts that 5% of its sales will never be collected, 30% of its sales will be cash sales, and the remaining 65% will be collected in the following month. Number 2. Farmers Delight receive other monthly income of $3,000. Number 3. The actual or expected purchases are $150,000, $120,000, and $115,000 for the months of September to November respectively. And 50% are paid in cash while the remainder is paid in the following month. The purchases for August were $120,000. Number 4. Monthly rent is $3,500 chargeable only in October and November. Number 5. Wages and salaries are 12% of the previous month's sales. Number 6. Cash dividends of $4,600 are declared and will be paid in September. Number 7. Long-term loan repayment of principal and interest of $4,700 is due in October. Number 8. Additional equipment of costing $8,500 is ordered and scheduled to be paid for in cash in November. Number 9. Taxes of $8,250 are due in November. So to prepare a cash budget, we need to know the format of the cash budget first. It consists of 3 parts, which are total cash receipts, total cash disbursement, and the cash balance and required total financing part. To calculate the total cash receipts, we need to sum all the cash sales, collections of account receivable, and other cash receipts. To calculate the total cash disbursements, we need to sum all of the cash purchases, payments of account payable, rent payments, wages and salaries, tax payments, fixed asset outlays, interest payments, cash dividend payments, and principal payments. To determine whether there is excess cash balance or required total financing, first we need to subtract the total cash receipts by total cash disbursement to get the net cash flow. Then we add the beginning cash to get ending cash. The ending cash of a month will be the beginning cash of the next month. Lastly, we use the ending cash minus minimum cash balance. If the value is positive, means there is excess cash balance. If the value is negative, means that there is required total financing. So based on the format and also the information, we can calculate the total cash receipt first. For September, the cash sales are 30% of the total sales for this month, which is $115,500. The collection of account receivable lag 1 month is 65% of previous month's sales, which is $253,500. Other income is $3,000, so the total cash receipts for September is $115,500 plus $253,500 plus $3,000 equal to $372,000. For October, the cash sales is $125,400. Collection of account receivable lag 1 month is $250,250 and other income is $3,000. So the total cash receipts for October is $125,400 plus $250,250 plus $3,000 equal to $378,650. For November, the cash sales is $128,700. Collection of account receivable lag 1 month is $271,700 and other income is $3,000. So the total cash receipt for November is $128,700 plus $271,700 plus $3,000 equal to $403,400. Next, we can calculate the total cash disbursement. For September, the cash purchases are 50% of the total purchase of this month, which is $75,000. Payment for account payable lag 1 month is 50% of the purchases of previous month, which is $60,000. Wages and salaries are 12% of previous month's sales, which is $46,800. Dividends are $4,600. So the total cash disbursement for September is equal to $186,400. For October, the cash purchases are $60,000. Payment for account payable lag 1 month is $75,000. Rent is $3,500. Wages and salaries are $46,200 and the long-term loan repayment of principal and interest is $4,700. So the total cash disbursement for October is equal to $189,400. For November, cash purchases are $57,500. Payment for account payable lag 1 month is $60,000. Rent is $3,500. Wages and salaries are $50,160. Equipment purchase is 8,500 and taxes are 8,250. So the total cash disbursement for November is $187,910. Lastly, we can determine whether there is excess cash balance or required total financing. All of the 3 months have an excess cash balance because all the values after deducting the minimum cash balance are positive. For September, net cash flow is total cash receipts minus total cash disbursement equal to $185,600. The beginning cash is $150,000. The ending cash is net cash flow plus beginning cash equal to $335,600. So the excess cash balance for September is ending cash minus minimum cash balance, which is $8,000 equal to $327,600. For October, net cash flow is $378,650 minus $189,400 equal to $189,250. Beginning cash is $335,600. Ending cash is net cash flow plus beginning cash equal to $524,850. So the excess cash balance is ending cash minus minimum cash balance equal to $516,850. For November, net cash flow is $403,400 minus $187,910 equal to $215,490. Beginning cash is $524,850. Ending cash is net cash flow plus beginning cash equal to $740,340. So the excess cash balance is ending cash minus minimum cash balance equal to $732,340. So these are the tabulation of the results based on the cash budget format. That's all from me. Now I'll pass to Simi to continue her presentation. Thank you.
Hi, I'm Simi. So I will be continuing with the question number 17. So for this question, it actually divides to 3 parts. For part A and B, you have to compile the pro forma income statement by using the percentage of sales method and also the fixed and variable cost data. For the part C, you have to choose the income statement which you think is more accurate. And for this question, it actually gives us some extra information, which the forecast sales revenue will be 2.25 million. And there was no borrowing obtained. The interest expense remained unchanged at 24500, and Bell's Manufacturing is also planning to pay some cash dividends of 85,000 during the year 2023. Alright, so and below are the extra information given by the question, which indicated the income statement and also the breakdown of costs and expenses into fixed and variable costs. Alright, so moving to the first question, we will have to compile the pro forma income statement by using the percentage of sales method. So actually this method indicated that the cost is moving in a sync with sales. Means that if the sales increase at certain percentage, the cost will also increase at the certain percentage. So firstly, we have to calculate the percentage. For the cost of goods sold, we will take it and divide it by the sales, and we will get around 61%. And we will repeat the step for the operating expenses, and we will get a 25%. So for now, to compile the pro forma income statement for the year of 2023, we will have to calculate the new cost of goods sold and the new operating expenses, which we will take the forecast revenue, which is 2.25 million that provided by the question, and we multiply with the percentage. Since that the first cost of goods sold, we got a lot of decimal place, so I have decided to take the fraction number so it will be more accurate for the answer. And for the latest cost of goods sold, I will get 1375000 for the year of 2023, and we will get 562,500 for the operating expenses. After we get the cost of goods sold and operating expenses for the year 2023, we can compile the income statement. So we will take the sales revenue that provided by the question, 2.25 million, and we deduct the cost of goods sold that we calculated just now, and we will get the gross profits of 875,000, and we less operating expenses that we calculated just now, and we will get operating profit which will cost 312,500, and then we will have to deduct the interest expenses which provided by the question, 24,500, and we will get a net profit before taxes, and we'll have to less the taxes, which is 40%. So we will take the net profit before taxes, which indicated 288,000, and we multiply with 0.4, which is 40%, and we will get the taxes of 115,200, and we will get, after deduction, we will get the net profit after taxes, which is 172,800, and we have to deduct the cash dividends, 85,000. So lastly, we will get the retained earnings of 87,800. Moving to the question B, we have to compile the pro forma income statement by using the fixed and variable cost data. So in this case, we assume that the fixed cost, it will never change. So for the fixed cost, it will remain as 750,000. And for the fixed expenses will also remain the same as previous. So it will be 155,000. And the only change is the variable cost and also the variable expenses. The way we calculate it is using the previous variable cost divided by the previous sales revenue, and we multiply with the forecast sales revenue. So we will get 437,500 for the variable cost, and also 368,750 for the variable expenses. So when we're moving to the income statement, actually it is the same with the previous one, but it will be a little bit different while we break down the fixed cost and variable cost for the cost of goods sold, and also fixed expenses and variable expenses for the operating expenses. So after the deduction, we will get the operating profits that will cost 538,750, and we have to deduct the interest expenses, which is fixed at 24,500, and we will get the net profit before taxes, and we repeat the same step as the previous one. So we will deduct the taxes, and we will get net profit after taxes of 308,550, and we have to deduct the cash dividends of 85,000, and we will get the retained earnings of 223,550.
So for the next question, which is, as the financial manager, which of the two pro forma statements would you regard as more accurate, and explain your answer? So based on what Sim Yi has presented just now, so our answer is when the firm has fixed costs, using the percent of sales method might overstate costs and understate the profits. This is because percent of sales approach assumes that all costs move in sync with sales, and therefore it is recommended to use fixed and variable components instead to compile the pro forma income statement.
Hi everyone, I'm Jising and I'm going to present question 22. Molten Metal Limited has assembled past 2020 financial statements, income statement and balance sheet follows, and financial projection for use in preparing financial plans for the coming year 2021. A. Prepare a pro forma income statement for the year ended December 31, 2021 using the fixed cost data given to improve the accuracy of percent of sales method. B. Prepare a pro forma balance sheet as of December 31, 2021 using the information provided and judgmental approach. Include a reconciliation of retained earnings account. C. Analyze these statements and discuss the resulting external financial requirements. These are the financial statements that provided by the question, which is income statement for year ended December 31, 2020 and balance sheet on December 31, 2020. Information related to financial projections for the year 2021. Projected sales are $420,000. Cost of goods sold in 2020 includes $72,000 in fixed costs. Operating expense in 2020 include $17,500 in fixed costs. Interest expenses will be $18,000 in 2021. The firm will pay cash dividend amounting to 25% of net profit after taxes. Cash and inventories are expected to double. Marketable securities, long-term debt, and common stock will remain unchanged. Account receivable, account payable, and other current liabilities will change in direct response to the change in sales. During the year, the firm will purchase a delivery vehicle costing $25,000. The depreciation expense on the new vehicle for 2021 will be $7,000. The tax rate will remain unchanged at 25%. To improve the accuracy of percent of sales method, we have to separate the fixed and variable costs. So we take the total cost of goods sold in year 2020 and we minus the fixed cost, which is $72,000. Then we divide the result by sales and it gives us 0.34. For operating expenses, we do the same thing. We minus the fixed cost from the total operating expenses in year 2020. Then we divide by sales and it gives us 0.12. This is the pro forma income statement for year 2021. First, we take the projected sales, which is $420,000, and minus the fixed cost of goods sold, which is $72,000. Then we minus the variable cost of goods sold, which is 0.34 multiple with the projected sales, and we will get the gross profit. Then we minus the fixed operating expenses, which is $17,500, and we minus the variable operating expenses, which is 0.12 multiple with sales. Then we take the number and add with the depreciation expense for the delivery vehicle, which is $7,000. After we minus all the operating expenses, we get the operating profit. Then we minus the interest expenses, which is $18,000. Then we get the NPBT, and we minus the tax, which is 25% multiple NPBT. Then we get the net profit after taxes. Then we minus the cash dividends, and finally we will get the total retained earning, which is $63,169.
For question B, prepare a pro forma balance sheet as for December 31, 2021 using the information provided and the judgmental approach. Includes a reconciliation of retained earning account. To complete the balance sheet, we need to take a look on information 6, 7, 8, and 9. Info 6, cash and inventory are expected to double. Info 7, marketable security, long-term debt, and common stock will remain unchanged. Info 8, account receivable, account payable, and other current liability will change in direct response to the change in sales. So we have to know the change in sales beforehand. To calculate that, projected sales divided with sales on 2020 and we'll get 1.2. After this, we use 1.2 to multiply with the amount of account receivable, account payable, and other current liabilities. Last info 9. During the year, firm will purchase a delivery vehicle costing $25,000. The depreciation expense on the new vehicle for 2021 will be $7,000. As we all know, a delivery vehicle is an asset. Hence, net fixed asset for 2021, which is $112,000 plus $25,000 minus with depreciation expense, which is $7,000, and we will get $130,000. Lastly, include a reconciliation of retained earning account. Beginning retained earning at net profit after taxes and deduct with dividend. You can get both amount from pro forma income statement and you'll get ending retained earning. Question C. Analyze this statement and discuss the resulting external financing required. The pro forma income statement highlights a profit of $63,169, suggesting that Motor Mentor Limited is positioned for profitability. If costs are well managed, the company can enhance profit margins as sales grow. The pro forma balance sheet proves that the company has invested in assets aligned with its operational needs and growth strategy. The external funding required of 2011 indicates a shortfall in internal funding for 2021. It shows that internal cash flow from operations and retained earnings were insufficient to fully cover the company asset growth or operating needs. Therefore, to help reduce reliance on external funds in future, the firm should adjust operating expenses or asset investment, thereby strengthening its capacity to fund growth internally.
So that is all from our group. Thank you.